Welcome back to the Teaching Tax Flow podcast, episode 134 today. We are joined by a great guest as we explore financing on a second property and what that has to do with your taxes. But before we do that, as always, let's take a brief moment and thank our episode sponsor.
This podcast is sponsored by Reps Tracker. Are you a real estate investor who is bogged down with the huge tax burden? Real estate investing can open the door to powerful tax benefits. Reps Tracker can streamline the process of accelerating these opportunities. To take advantage of a special TTF community discount, go to teachingtaxflow.com/reps, R-E-P-S, and use the code IFG. Better yet, click on the link below in this episode's show notes to go directly to the Reps Tracker sign-up page.
Hey everybody, and welcome back to the Teaching Tax Flow podcast. As always, we find the brightest people that are out there to join us as a guest. We have to say that because I can't let everybody think that Chris is the brightest person that we always bring on this show because, if we give him a big head, he won't be able to fit through a doorway. So we keep him in check that way. So as you've seen in the title and the show notes, if you haven't taken the time to read those yet, I'm going to give you the little brief synopsis of what it is. We are going to talk about what it is and how it relates to taxes. So what it is today is financing a second home. So you might be thinking, why in the world are we trying to relate that to taxes? Well, if you don't know why, we're going to dive into it. If you do know why, you know exactly how we're going to tie those two together. So without further ado, Chris Picuro, welcome back to your own show, sir. How are we doing?
Oh, I am doing great, John. I have my favorite color on today, purple. So if those listening on Spotify, Apple, just jump on to YouTube so you can see this beautiful color. But no, I am doing great. And everyone knows that financing and taxes are very related. We talk a lot about bankability and taxability, and your tax return has a direct effect 99.9% of the time on purchasing a second home. There are obviously some programs out there that don't look at tax returns, but I'm not the one to discuss that. We have an expert. I would say, in my opinion, the best way to describe Parker is she is a powerhouse in her industry. And I'm so excited to have her on this podcast. We're going to talk about financing a second home. And Parker is the branch leader and at Wealth Builders Mortgage Group, powered by Movement Mortgage. But she also owns and operates many short-term rental properties. And why that's important is when you're taking advice from someone, you want to make sure they're eating their own cooking, right? And that's very important to us. So, Parker Borofsky, welcome to our show, the Teaching Tax Flow Show. How are you doing today?
Doing great. Thank you. I'm really excited to be here. I love just sharing. I'm a mortgage nerd, so the more I can share, the better.
Well, that's good. Well, we're nerds also in our own little ways. Probably big
Perfect.
ways. Pretty much nothing I do is not nerdy, except maybe anything related to baseball, but everything else is really nerdy. But
I thought you were going to say something else there, Chris. I thought you were going to say a different sport that you
no, I'm not going
always
to mention
do.
that
So,
sport. I'm not going to
there you
mention
go.
that sport. But no. So welcome. Before we dive into strategizing, because I think a lot of times what people forget is that the mortgage application occurs before you click submit, right? You've got to, just like you stage a house, you stage your tax return. We legally and ethically reduce the tax you pay in your lifetime by staging the return, making it within the rules look to your benefit, and as a taxpayer, to reduce your tax. And we know that you've got to kind of stage your finances, maybe stage your credit score to get the best rate, the best acceptance possible. But before we dive into all that and how to finance a second home, tell us a little bit about your history, a little bit about yourself, and how you got into the mortgage business and then into operating and owning short-term rental properties.
Awesome. Yeah, thank you. Those are long stories. We'll cut them into little pieces here. So essentially, after graduating college, I went into timeshare marketing, not sales, marketing, big difference. For those of you who are timeshare salespeople out there, you have a skill set I will not have. So I did timeshare marketing for 10 years. And that's how I eventually ended up from San Antonio to Tennessee. And then once we landed here, my husband got an engineering job in electronic engineering at Denso, which is a big manufacturing plant. And so that gave me freedom to explore. We had just purchased a house. So I told my loan originator that, I was kind of interested in what she did. It seemed kind of cool. And she said, well, after closing, not before, I'll get you an interview with the managers there. So I did. And it was kind of weird. It was serendipitous, actually, because when I went in for that meeting, they said, hey, do you know Dusty Tunkin? And I said, well, yeah, he's big with Wyndham. That's who I'd worked for. And they said, well, do you know his dad owns half of this mortgage company? I was like, no, I had no idea. So it was kind of like the universe coming together. It was very interesting. So that's how I started in mortgage. And then eventually I met Avery Carl about a year later and financed some of her properties in the Smokies. And as she grew her business, I started financing a lot of clients. And I noticed that clients were coming back and purchasing 2 or 3 properties, which was interesting. I was like, okay. And then when they would bring their bank statements to me, I was seeing all the Airbnb deposits. And I was like, okay, I can do the math here. I know the mortgage payment. I see these deposits. Like, this is good. And so 2018 is when we bought our first, actually 3. So we closed on 1 in January and 2 more in the fall that year. So that's how we got started. We now own 12 short-term rentals. We're generating over $1 million in gross revenue each year. And I love the community. And then financing wise, so financing short-term rentals and complicated situations, blessing and a curse, but it's turned out to be my superpower. So give me 10 business returns, I'll pick them apart. So yeah.
That is a superpower. No doubt about it.
Yes. And just a reminder, I'll take easy ones too.
Right.
That's a great
layup once in
disclaimer,
a
right?
while isn't a bad idea, I've got to
Right.
imagine the mortgage business, it's kind of like, one of the things I preach all the time is there is no such thing as an easy tax return. And when someone says they're an easy tax return, it's not. Like, they just don't have an idea. Like, I'll give you an example. Someone could say, "Oh, I've got a W-2, I've got maybe a couple little things," and then you get into, oh, well, you know what? I ended up getting, legally separated. And now the divorce is fine. Well, who's claiming your independence? Oh, I don't know. I got to look at, it's never easy. So you could have someone that's a quote easy mortgage company or more easy application. And then you start asking them questions. Oh, well, yeah, I bought a car last month. So I took a lot of money out of my savings and now I'm like, oh my goodness, no. So I empathize. I don't think there's probably not many easy ones, I'd imagine.
No. I call them gotchas. There's always little gotchas I try to stay 2 steps ahead of. So luckily, we're really good at that. So it's turned out to be awesome. I've actually closed over $1.1 billion in short-term rental loans in the last few years. So
Wow.
it's a lot
So
of loans.
let's dive into someone buying a second property and kind of what those buckets are going to be. Because I'm imagining someone could be buying a second property that's simply a second home, a cottage, something they're never going to rent out. Someone might be buying something that they very rarely step foot in, like a short-term rental property. Someone could be buying just a single family home. Or maybe let's just take it into like a 4 or 6-plex, smaller apartment building. What are some of the things that that someone has to think about before buying the property? Obviously, use. And what would that first step be to say? It's almost overwhelming, like, and it probably it all comes down to it depends on what loan programs are out there. But what are the most common type of taxpayers you and your team work with that are buying a second property? I know you said short-term rentals, but
Yeah. When you say the common type of taxpayers, what do you mean?
yes,
Like,
yeah, common type of taxpayers are yes.
so we've got, everything from W-2 earners, self-employed. Sometimes we're qualifying clients just based off of rental income once they get to a certain point. So the second home, there's so many different products that can be used now, and there's 2 different definitions, right? And actually, this is something we can probably clarify with you as well. So, second property, number 2 property, right? You can purchase that as a second home, which is if it's a conventional loan, 10% down minimum. Investment occupancy, which is minimum 15% down. Or you can use some of the non-QM products, which are typically going to be 20% down. There are some cases we can do a 10% second home non-QM product as well. So when you say a second property, yes, can be any of those categories you just mentioned. Now, second home category, though, that one where you can put the least down payment. Let's talk about that for a second. So I get this question all the time, and I do always tell them to defer to their CPA because I get the question of, well, if I buy a second home, can I still write it off on my taxes? So here's what I tell them, and then I tell them to go check with the CPA.
Right.
I tell them my understanding is yes, as long as it meets the IRS definition of investment property, you can. And so maybe can you answer that for me?
Sure. It's situationally dependent, of course, like anything, but here's the situation. If you buy a second property or second home, if it is just a second residence, let's say you're a snowbird. And I know, Parker, you guys spend a lot of time in the beautiful Emerald Coast and have properties there like
Yes.
us.
Yes.
But let's say you're a snowbird. Absolutely, you can deduct your mortgage interest and property taxes as an itemized deduction. It's considered a second personal residence. Now, once you get to the point where you start renting that out, then that moves in general onto Schedule E as a rental property, and then that's at that point you can then start deducting all of the expenses, maintenance and insurance, and but there are different rules depending on one, is it considered what's called a short-term rental or an STR for under code 469, section 469, or is it considered, if it's not a short-term rental, then it's a long-term rental. Midterm rentals are still considered long-term rentals. There's no midterm
Okay.
rental in the tax code. And then you have to look at your use days. Is there mixed use? Are you using it personally, or are you not using it personally? But the bottom line is, once you start renting it out, 99.9% of the time, it's going to go on the Schedule E, not Schedule C. It depends.
Thank you.
Yeah, it's Schedule E. And unless you have it in like a partnership or some type of multi-member entity. So
Definitely. Okay, great. Yeah, and something else I remind clients of, because if we're doing a conventional Fannie Freddie loan, and some of the jumbos and some of the non-QM as well, they each have different guidelines. But we can do a second home loan with 1031 funds. However, because mortgage and taxes, they run parallel. They don't really intersect much, except for qualifying. But the IRS doesn't care what kind of loan you have. If you have a second home loan, the IRS doesn't care, right? They're not looking at the loan type. They're looking at your usage. Is that?
absolutely. And that's a great point. A lot of times I hear clients say, well, um, I'm buying it as a primary residence, but I'm going to convert it to a rental. So, okay, that's fine. Mortgage qualification is completely different than that. The IRS doesn't care. What they're worried about is an ordinary and necessary expense. Now, obviously, if someone buys a property, there are rules with legality issues that I'm not going to touch on as far as what your intent of the property is. But a lot of times, what we see is that someone might go with that 10% down loan as a second residence, and then subsequently, after owning it a little bit, they might decide to rent it out. Because you could still have a short-term rental property or short-term rental tax loophole qualified property on any type of mortgage. The mortgage type really doesn't matter. That comes down to the use. The use of the property dictates how you report it on your tax return, not the type of mortgage that you have. So,
Yeah, absolutely. Yeah,
no.
and what's
Mhm.
that?
Oh, well, I'm sorry I did interrupt because I'm really good at doing that. You mentioned QM. You said non-QM. Can you clarify
Uh-huh.
that for maybe someone that isn't familiar with that term?
Oh, yeah, absolutely. So, so your typical loan types, your conventional loan, Fannie Freddie, those are called qualified mortgages, or QM. And what that means is that those loan products meet the requirements that the Federal Housing Finance Agency and the CFPB put in place after 2008. So there's very specific ways we can calculate income and how we can look at that. When you get into non-QM products, these products allow more leniency. So this is where they allow, so non-qualified mortgage is what that stands for. It just means it doesn't meet those definitions and requirements that the government set forth. So this is where, so DSCR, debt service coverage ratio, is an example of a non-QM. Bank statement loans, where we look at your gross revenue on bank statements, is another on a non-QM. And there's even full doc non-QMs. And Chris, I don't think I've even told you about this, but we have a really cool full doc product, which means it's a non-QM loan, still based on your debt to income ratio. But what it allows, if you own short-term rentals, instead of looking at your tax returns to calculate the income, we can take the most recent 12 months gross fronts and 80% of that and just use it flat out.
That's awesome. I know that the thing is, there are products for almost everyone's situation.
Yeah.
You mentioned, because a lot of times there are no easy mortgage applications, but quite frankly, people with high W-2 earnings that in stable jobs are considered less risk, in my opinion. Even though as entrepreneur of over 20 years, I don't look at, I mean, entrepreneurs kind of
Right.
going to that higher risk category. But like you said, there are products available for someone that receives a 1099 and consistently. Um, so
I'm closing one on a 1099 product this week. Yep.
why? So on the not so there so basically you've got the qualified mortgage and then the non-QM buckets. Um, in your experience, what's the breakdown approximately of between QM and non-QM on second property purchases?
I do a lot of conventional second home products. The benefit, so oddly enough, the interest rates right now between the non-QM and the QM loans aren't really that far apart.
Okay.
The biggest difference is going to be typically with those non-QM loans are going to want slightly higher down payments. So
Right.
like right now, the rates, the 10% down non-QM, the rates really are not pretty. But once you get to 15 or 20% down, then they start looking a lot more like the conventional loans.
Mhm.
So so they're good. But that's the drawback. Since they're a little riskier, they want a little bit more skin in the game to get those lower.
Right. But a lot of
Mhm.
people like we out there, and in the real estate business, it's you marry the property and you date the rate. So if you're listening to this or know someone listening to this that already owns a second property, and let's say they're kind of grumbling, oh man, I wanted to close in 24 with maybe it's a short-term rental with a higher bonus depreciation percentage, but golly, I'd really like to refinance it or take a look at that. Is there typically because this is about financing a second property. It doesn't mean it could be a property that you already own. Um, I'm going to pivot back to applying, but since we're on this topic, when does it make sense for someone to consider refinancing a property that they're in right now? Because I know some of the QM, I can tell you in personal experience, sometimes there is a prepayment penalty. But again, you got to look at the break even point and how and that sort of stuff. But yeah, when should someone consider talking to you and your team about refinancing a second property?
Yeah, absolutely. So so going back to the second or third or fourth additional properties that you own. So when to refi, well, first of all, let me start by saying right now, I wouldn't recommend anybody do a loan with a prepayment penalty. I mean, we've got loan, or at least not more than 12 months. So our QM products do not have prepayment penalties except for the DSCR. You have an option, but we also have great rates on no prepay penalty. So I typically look, I know short-term rental investors out there because I am one, right? And yeah, you might think you're going to hold on to this property for the next 3 years, but then you get, then you see this shiny object and then you want to sell, tap into equity and buy this other one. So that's why I really don't that. And I do believe rates will come down in the next few years. So currently, if all those of you listening out there, please really make sure you want to do anything longer than a 1-year prepay penalty. Now, when is it time to refinance? So it depends. So if you have a higher loan amount, the rates need to drop less than if you have a lower loan amount. So if you have $1 million loan amount, you may be, if rates drop half a point, it could be worth it for you. But if you have $150,000 loan amount, it really may not, the cost of the refi may not be beneficial until the rate drops 2%. And then also depends on what state you're in. So Florida is the most expensive state I'm aware of to refinance in because they charge mortgage stamps, which are pretty high. And so this is where I would encourage you to get with your lender and look at the costs, the closing costs versus your monthly savings, see how long it's going to take to recoup. And that's how you determine. And those in the middle that have, I'd say, I don't know, $400,000 to $1 million or 800 or 900, probably about a point when the rates drop to make sense as a general rule of thumb.
Well, that's a great rule of thumb.
Mm-hmm.
Yeah. So thinking about that financing a second property, obviously your down payment can range based on a variety of things. And I would imagine, when we talk about second property, it could even be let's say someone is a vet, let's say someone's an active military person. They live in your original hometown in San Antonio, they're probably in the Air Force, maybe, we'll see. And let's say they are moving somewhere else, and they need to buy that next house before they sell the other one. They might just rent the other one out. They might keep it. They could potentially, could they get a VA loan on a second property potentially? And what are kind of some of the rules there?
That you can, yeah. So if you're moving into, now very important, the VA has to be a primary home.
Right.
You can though convert. If you're
Mhm.
moving, you can convert that one to a rental. You don't have to refinance it. It's fine.
Yep.
Yes, you can have 2 VA loans at once. There's a certain calculation we have to take a look at to see how much you could qualify for. It's kind of a weird percentage and fractions thing. But yeah, we can look and see how much entitlement is there and what they would qualify for a second VA mortgage. There's also, they could refinance that one out if they wanted to. The first one, there's a one-time restoration of benefits they could apply for. And then for those out there who have VA loans, just so you know, typically, except for that one-time restoration, if you ask for it and they grant it, typically just refinancing a home is not going to replenish your benefits. You'd have to get that house also the title out of your name. So you'd have to refinance and get the title out of your name in order to restore those benefits.
Gotcha.
Typically. Mm-hmm.
Well, let's talk about, as we kind of wrap things up, because we were definitely going to have you back to talk about some more mortgage issues. I'd like to start diving more into the primary residence. But on the second, let's think about, or let's kind of give people some pointers on if they're thinking about buying another property. What's the time frame for one, contacting their mortgage partner, and two, what are some of the things they could be doing to kind of prepare financially for that application? Because ultimately, it's a snapshot of where you stand the day you apply, with a little bit of look back on your income. But what are some of the things they could do to cast themselves in the best light, we'll say?
So the beautiful thing, so when we initially talk to a client, that data is not permanent. So I'd say before you've got to talk to a mortgage person before you know how to prepare.
Okay, great.
So yeah, definitely. So as soon as you start even thinking about, before you open Zillow or Realtor.com, as soon as you start, or if you do, start browsing, that's when you need to contact a mortgage professional, because that's when you need to get a good idea of where you stand. And also, if there are things you need to work on, that's where they can provide guidance. And so, but without knowing your situation, like we can do a soft pull on your credit, which is important because it imports your monthly liabilities that we have to take into account for debt to income ratio. We can talk about how much money do you have saved for down payment? Where is that going to come from? and you can talk to somebody who knows how to help you best prepare for the down payment. So, yeah, I'd say as soon as you have in your mind that you possibly want to purchase a second property, that's when you should contact a mortgage professional. And if you talk to somebody who doesn't seem like they understand, talk to a few people. Or if they're not giving you if something doesn't feel right about what they're telling you, and especially if you talk to a loan officer who's very limiting, like, no, you can't do this, no, you can't do that. They just probably either they don't have the products and they don't want to tell you that, or they just don't know better.
Right.
There are a lot. So back to the second home. So not necessarily a second property, but that second home loan, that 10% down. There is absolutely nothing wrong with buying a second home and renting it on Airbnb. As long as you're buying it with the intention that you're going to use it some portion of the year, meaning, some people get 1 week of vacation a year, some take 2, some take a few weekends here and there. Whatever your definition is of going, they just want to know that you also personally want to use that property. So, but as long as you intend to occupy that some portion of the year, totally fine to rent that out on Airbnb the rest of the year.
And that's a QM 10% down second residence product. Is that? Yeah. That's what I see the most popular on that first short-term rental property. A lot of times it's going to be that 10% second home loan. So, no, that makes sense. And again, you want to work with people that have done it themselves. Like, so eat your own cooking. I mean, that's life in general, right? And then once you sit down with somebody, prepare yourself, because especially now in that environment where you're making offers, you need to make sure that you have your lending lined up, ready to go. And you need to be really transparent, right? I mean, you've got to, if there's someone on your credit, they're going to find out eventually, or something. Just be honest, and because you'd much rather be partnering with your mortgage professional now instead of it later on. Like, well, you didn't tell me you had a tax lien in New Mexico. Well, I didn't want to say anything. Oh, I worked there in a couple of years and I just have a tax bill I never paid. Those little things could be a big problem. So
Definitely.
And Parker, actually, a question for you too before we really wrap up. So I know
Yeah.
we started this conversation off a little bit, right? Like there's likely a product for every situation, depending how air quotes simple someone may
Right.
think it may be, or how complicated it is, right? So, without going into a lot of detail on a example of a complicated situation, for anybody that's listening to this, maybe they think, oh well, I'm pretty sure that I'm not going to qualify, or I'm pretty sure that, my situation is too complicated. Like what would you say to somebody like that? I know obviously you mentioned, talk to your lender, your professional that you have kind of in your proverbial Rolodex, or yourself. But what else would you tell them besides that, maybe to comfort them a little bit and going into that conversation?
I get those calls every day. And people feel like they start the phone call like, yeah, I know you're probably going to have a hard time or may not be able to qualify for anything. And, like 98% of the time, we'll either figure out a way to make something work for them, or set up a game plan for the future to help them understand what they need to do, whether it's credit, whether it's where are they going to get down payment money from, or whether it's how their taxes, how their income came out on their taxes, or maybe they just started a business and they need to have 1 full year before we can work with that income. So yeah, no, I get those calls every day, and I kind of smile inside because I know that typically I've got a way to help. And I've had clients that have told me they've been turned down I had one that was turned down by 20 other banks and lenders. I was his 21st that he came to, and now we have financed 12 properties together.
wow.
So, so if you're being told no out there, but you've got something to work with, keep going. Call me. Call whoever you need to call. But stay passionate. I mean, I have qualified people literally not just rental income, 4 or 5 properties of rental income. There's so many great products these days to choose from.
Excellent. And that's
Yeah.
a great response to it too. And I mean, and again, being a marketing guy, I think that just the general population, if anybody spends any time online, right, they've probably strongly associated themselves with a triple digit number, and they almost qualify or disqualify themselves what they think is going to be the situation, which
Yeah.
it sounds like that's usually not the case. Or even like what you were saying there, and that I know we will wrap because we can go off on a whole nother conversation,
Yeah.
which we should
Yeah.
have on this. But
Yeah.
you probably find yourself adding so much value to those conversations, really being a financial coach, in lack
Mhm.
of better terms, right? Like,
Yeah.
because you know what they're looking for, you know, really their story, you know, their situation, and
Mhm.
you know, you really, I mean, there's a lot of trust in it. Same thing with you, Chris, right? Like, what do they say? Your tax professional and your hairdresser, or your
Yeah.
like indirect
You had to bring
psychologist or
another hair
something
Oh,
joke
along.
out, you
I love
slug.
it. Yeah, you had to. Yes, yes.
You know, it's
Yeah.
funny as I thought about it mid comment, I'm like, there it is. There's my opportunity.
Well, here the
Yes.
thing is, the mortgages and taxes are very similar in so fact that from if you have there's certain people have the mentality that they're just a commodity. And eventually people that understand what's going on understand that they're not a commodity. It's a relationship that you have to have. So that's why
Yeah.
we're so excited. I mean, I'm really happy we have this podcast episode. A little
Yeah.
teaser. I think that we're going to try to twist Parker's arm to. We really want some more content for our Teaching Textile YouTube channel because I know that she could dive into some of these things um, in more detail. And I think a great video talking about, hey, when someone says no, that's okay. There's a ton of people. I mean, gosh, there's so many examples out there, not just in the mortgage world, of people that um, you know, get one college scholarship offer and then they're Major League Baseball now, or they just need. I think if you're listening to this, first of all, thank you, by the way, and but if you're listening, if you're not listening to this, you have no idea that I just said that you're listening to this. So I don't know why I even say if you're listening to this. You are listening to this if you're hearing me, but understand that um, your mortgage team is your partner. That's a partnership, and you need them. They guess what? They want to give you the mortgage too. Okay, that's the kind of the
Oh,
cool part
yeah.
about this, and
Yep.
we appreciate it. And we're definitely gonna coerce Parker into giving us some more content.
Yes. And I would like to leave you all with a message. Um, Two, actually. Number one, don't DIY your DTI. And your debt to income ratio. That's what that stands for. Don't DIY your debt to income ratio. You'll sell yourself short every time. Number two is friends don't let friends DIY their DTI because they will sell themselves short every time. Get with a professional. It's complicated. Different products have different guidelines. So, yeah.
That's a great way to close it out. And really, for anybody again that's listening to this, I mean, obviously, Parker, thank you so much for joining us. And I also just realized too that your last name may be one of the only ones that I've seen in a very, very long time that ends similar to mine, SKY instead of SKI. So we'll
Yes.
have a whole conversation on, that joke side of things that I've been getting my entire life. But again, for those of you that are listening to this, I mean, you you've obviously been listening to it for a while, or you've chimed in halfway through, or hopefully from the beginning. But think about this, right? Like you've just listened, basically eavesdropping in on a conversation from two different people that really are helping you get to the same place that you want to, right? Like, unfortunately, Chris, I'm going to put you in the not as sexy hot seat, right? Like nobody gets excited about their tax or paying their taxes. But the caveat is the better you're prepared for that side of things, the better you're likely prepared for purchasing that second home or your first home or anything along those lines too. So you've heard the conversation between the two people that could probably help you the most. I mean, not necessarily you have to go to these two people, but in general, those two professions. So take that to heart. A lot of advice came here. My pen is sore. If anybody's watching this, they've probably seen my arm move, and I'm writing on my sticky notes on my legal pad as always. And Parker, I look forward to doing those little snippets with you if we can get you on our YouTube channel, because I think there's so many like specific questions that I think we could answer and dive in. And I know there's a ton of stuff. It was very easy for us to go off into a rabbit hole and end up popping up in a completely different world. So we'll have to behave ourselves, I think, in that regard. But again, Parker, thank you for taking the time to join us on this one.
Thank you guys for having me. I really appreciate it.
Excellent, excellent. And yep, if anybody's listening to this, obviously, if you're listening to it, be sure to check it out on YouTube as well. We have our YouTube channel. Subscribe to that. It's extremely easy to do. Don't be lazy. Subscribe to this. When we do release some more content, you will absolutely get a notification because it's automated. You will literally get a notification when we release something new. Conversations like this, we have a schedule, I think, built out for the next 2, almost 3 months of some fantastic guests, some great topics. And as always, keep the questions rolling in. If you have something you want to hear or you've heard you want to hear more of, shoot it our way. Defeatingtaxes.com is our private Facebook group. There's your free invite. I feel like we're giving away a lot of free advice and insight here today, but that's okay. That's what we're here for. Check it out, defeatingtaxes.com. Join that group, and we will see you back here next week on the Teaching Tax Flow podcast. Different day to same day of the week, completely different topic. There we go. I tweaked it a little bit. So thank you everybody for listening, joining us, and have a great week.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.